Good morning, everybody. Welcome to the morning meeting of this virtual hedge fund experience we call ARMR Investing. Thanks for joining me. Let's dive into thoughts on the market and how we're executing. So what I want to do is kind of break this down into read and react, how we execute based on risk monitors and the different portfolios we run. And then I'm going to talk to you about some macro big picture. Okay. And you can check out the website if you want to read the whole captain's log today. It's a little bit longer than just a YouTube description, so you can go there and read it. All right, but the first thing I want to do is talk about just in the moment, read and react. What are we seeing about the market and how do we want to behave? So let's start with the risk monitor. Let's start with what's the market doing. We've got a market that's wobbling, that's dangerous, but keeps grinding higher. So that's still the story. And I kind of been singing that tune for the last, I don't know how many weeks now. Weighted indexes, the top 10 names carrying the whole market, NASDAQ 100 higher, S&P 500 higher. But when you look at the weighted indexes, you're not getting the confirmation. So that hasn't changed. There's a picture of the NASDAQ 100. This is the leader, okay? And, so it's trying to break out of this basin here. And, you could argue I could move this yellow line right up to here. Okay. And the reason I would do that is this day right here was that fateful day in May, my birthday of last year, May 4th, right? Where the market finally started to believe the Fed was going to raise rates in an aggressive way. And it led to this chopping bear market of last year. And so the high of that bar, right, would be the key level. If you could break above the high of that bar, which it tried to do here and failed, leading to a pretty vicious sell-off. But if it could break above that high, which we're not quite there yet, then maybe the market's saying, hey, we digested all the Fed rate hikes and we're ready to, go higher. Until then, what you're looking at is a market that's going right up to the top of a rectangle. And, you could argue right back down to the bottom of the channel as the Fed keeps raising rates, if that's the key. But see, here's the confirmation that we're not getting, right? So, and this is where we have the yellow line here for the equally weighted NASDAQ 100. Not even challenging, can't really get off the mat here, just kind of flat to the 50-day moving average. And the S&P looks the same. So there's the S&P, and this, to move it, this should be moved up to right there, which matches what we just did with the NASDAQ 100. So that's actually where the market began this kind of chopping bear market. That day, May 4th, that white bar right in there, okay? Then we tested and failed, and we haven't quite gotten up there yet. All right, and then of course the equally weighted S&P looks god-awful. And of course it looks god-awful because you've got the Fed now I'm just going to publish this picture for you so you can see it. Just in case you wanted a graphic representation of what's happening. Okay. The Fed's doing this, right? That's the effective Fed funds rate, and this is what's happening to regional banks, which are totally collapsing, right? So as the rates kept stair-stepping higher and CEOs of regional banks either didn't prepare correctly or can't prepare correctly, you could argue they can't prepare correctly. And the reason you would argue that is the way banks are set up. If you can get better than a 5% risk-free rate in U.S. Treasury bills each month, like literally next month, July, I could do it in July over 5%. Who would keep money in a regional savings bank getting 0.5%? That's just logic, right? I mean, that's just logic. And it begins as a slow drain. And then as you could see what happens in that chart, it becomes an aggressive drain, right? So there was this moment in time where, okay, 2.5%, whatever, I'll leave my money in my savings accounts. It's kind of easy. I may as well just keep doing what I'm doing. 5%, that's just stupid money. I have to move it. I can't sit there in a regional bank, and that's why we're having regional bank problem. All right. So what does somebody do in a market like this where we see clear signs of no confluence, only a handful of names driving the market higher and all these things? All right. So I want to refocus on the ARMR Investing Way this morning and share with you that in any market, a particularly difficult market, diversification is key. But it's not your granddad's diversification. You can't buy a whole bunch of different stocks to diversify because everything's almost 100% correlated. You can't go out there and go 60-40 bonds and stocks because that got blown up last year. So that doesn't work. People talk to me about emerging markets. Who are you kidding? They follow the U.S. markets. U.S. markets crater, dollar goes through the roof. Guess what happens to emerging markets? We are long gold. We made good money trading gold and silver. Now all we have is a gold position on. I get that. I'm going to hold that 10% gold position. But commodities look like they're about to struggle in a significant way for a whole host of reasons. So I submit to you the ARMR Investing Way, just to get back to our roots, is to diversify through style of management. Now, if this is difficult to do when you have one portfolio, we all have different brains. This is why women make such great portfolio managers, because they're able to divide their brain into 10 different things at once. Men struggle a little more with that. So what I do, my own portfolio, is I literally split it into 3 pieces. At Interactive Brokers, where I run capital, if I'm doing this for somebody else, I do it for myself. I do this for myself for sure. I can do duplicate accounts. So I can have up to 5 duplicate accounts and manage each account differently, following a different discipline. And it's the style of management that protects me in a difficult market. And my job then is to decide how much capital to be in what discipline at any given time. So the 3 disciplines are day trading the indexes using the ARMR day trading playbook. So let's just take a quick peek into that, what we did last week. Okay. So just as an example, even in a hard day yesterday, I know Stephen was on this with me at the close. I don't know if you all were trading this, but so this was a tough day on Friday, but resulted in profit. So you come into the day, all you have is 100% cash, right? The day trading portfolio right now, I got 100% cash. Woke up, comes in, see what the market's doing, look for ARMR day trade setups. Can be a gap and go, a gap and no, mean reversion, whatever. Normally I'm mean reversion trading, okay? And that's what worked on Friday. So this was a gap up, an immediate sell-off. You could have been short right there. This is a gap and no to a certain degree. But I generally like to look long first and then short. So I didn't short here. Comes down, sets up a bottom. I'll trade that every time. Got long right in here. Remember that? We were buying close to the low of the day. Popped, doubled my position, broke down 3 bars later, out of my position completely, took a small loss. Okay, comes down in here, and I highlighted this, and I said to you guys, I'm not putting this trade on, but I can understand why someone would try it. Okay, but I wasn't putting that trade on. Wrong time of day, no day trading setup for me, and it continues lower. This was the beginning of the afternoon move. It starts at 1 o'clock. Time is very important in these types of trades. It starts here, but sets up a bottom between 1 and 2:30. Now, after 2:30, this is happening a lot in this market, and it's a mean reversion trade. And it happens more and more frequently, I believe, because of zero-dated options. The puts expire, the puts deteriorate faster than calls. So the market's down all day, and you get into 2 or 2:30, people dump their puts to book their day trading profit, and the market rips higher back to the VWAP. It's a mean reversion trade. And so we got on that trade here, and you can see the money we make here is larger than any money that was lost here, even if you took this trade, which I suggested you shouldn't, but even if you took that trade, you had a couple of losses, you would have been able to turn a profit by the end of the day trading that last mean reversion trade. We saw another mean reversion trade that was even bigger on this day. This was a wild day. This was Wednesday of last week. Okay, total mean reversion. Gap and collapse. This was a risk on entry point that failed, right? And then there was the day trade setup that ripped to the close. All right. So different styles of management. I come into my day, I've got 100% cash in a portfolio, which is by definition the most conservative way to run money. I have cash overnight. I come in, look to put the cash to work each day. I'll go long or short the indexes. Long the S&P, short NASDAQ, Dow, and small caps. That's how I do it. Okay? So I'll be doing that this morning. We'll see what happens. Market will open. We'll get a day trading setup. I'll put money to work in that portfolio. The next portfolio, and that portfolio has nothing to do with risk monitors or macro or anything, right? We just look at what the setup is. We trade the setup. That's it. The swing portfolio is the next style of management, and that really leans heavily on the risk monitor. Risk monitor is red right now. That portfolio is carrying max cash. That portfolio can swing indexes, group ETFs, or ARMR Power Plays stocks, but it really follows the risk monitor. If it's red, it's max cash, which means every now and then there might be a trade in there, but almost never. That portfolio is just sitting in cash, collecting yield in treasury bills. So I'm trying to describe this to you in a different way that I have been before. I've been conservative, aggressive, whatever. But what I really want to do is show you how I run my capital. And then you decide how to take the information and allocate it on your own. Okay. So when I say to you, my conservative portfolio is 100% treasury bills, that's what I'm talking about. That swing portfolio follows the risk monitor. It's been cash for a long time. And every now and then it gets in there. That's the portfolio that was up a little over 5% last year. We sat in cash almost all year. We had 2 trades, made money. That was actually the second trade that made us money at the end of the year. That portfolio, again, is just sitting in cash with some gold exposure. I did trade the precious metals in that portfolio this year and made money. And I still have 10% gold. So 10% gold, the rest treasury bills. And it will not put money to work unless the risk monitor changes color. Goes yellow, I'll put half the capital to work. Goes green, max invested. And then the third portfolio is my investing portfolio, more traditional investing, heavily leaning on the ARMR research reports, the whiteboard, the power play list. So when you see Google, Amazon, AMD, CRM, Netflix, HubSpot, Eli Lilly, those stocks are in the ARMR Invest portfolio. They follow individual ARMR algos. They don't necessarily follow the risk monitor. The risk monitor only determines position size in that portfolio. So if the risk monitor is green, max position size, red, minimum position size, yellow, obviously in the middle, right? And if you want to give me, okay, give you some numbers. Minimum position size, 5%, max 10, obviously 7.5 would be the middle. So this is a simple way to run money, right? If your risk monitor's red, I only put 5% of my capital in each idea, right? If it's green, I'll put 10. Okay? That's the strict way to run the money. And so I have 3 styles of management. I would say that investing style is the most aggressive because if the market craters, it's going to get hit the hardest, right? So, and I would say swing trading is in the middle, and I would say that obviously the index trading is the most conservative. There's no individual stock risk. There's cash overnight, right? So what I try to do and what I struggle with, we all struggle with, we all have to figure it out for ourselves, figure out your risk tolerance and how you want to approach this. But what you want to do is based on the world around you, the market, the macro, whatever you think, right? Or forget about all that. Follow the risk monitor. red, green, yellow. You allocate more or less to different endeavors. If you're not a day trader, you say, I don't want to trade the indexes, fine. Then you have the other two disciplines. How aggressive do you want to be, right? Swing trading algorithm, portfolio, max cash and gold. So you got to figure out how to do that. I like to trade all three. And if you ask me right now, where am I over allocated? I'm under allocated in ARMR Power Play investing style. It's because the risk monitor is red. And I'm going to go over with you now. I have a very hard time. Not only is the risk monitor red, but there's no confirmation anywhere. And all these things I've already told you that really disturb me. And I'm going to go over with you a Hugh Hendry piece. Now, I'm going to do it in a minute. And I'll talk about that. I'll talk about that in a second. What developed last week is really disturbing to me in the US dollar. Okay. So there's just such a myriad of problems to me that when the risk monitor is red anyway, it helps me under allocate my investing portfolio, but it's like really under allocated right now. I almost don't want to do it, but I follow different styles of management because the market makes fools of most of us most of the time. Market climbs a wall of worry, blah, 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 all those things. So I use different styles of management. And if that portfolio blossoms, then I know it almost helps me shift capital, right? If I'm making money in that invest portfolio, the risk monitor goes green, boom, it helps me get more aggressive, right? So instead of shutting off a style of management, you do all three and you see where the success is and you add to that process. So anyway, I'm under allocated to my investing side, smallest position size. I gave you the 5, the 7.5, the 10. It doesn't mean I do that all the time. I could be at 3. I mean, everybody has to make their own choice. I'm just giving you a ballpark. So I'm carrying really a maximum cash position, and this is the primary reason why. I reprinted for you a Hugh Hendry piece, a tweet that I thought was just perfectly on point to dovetail with the biggest issue that I see in the market right now. And the biggest issue I see is here. Okay, that's a major problem for the market. We need the US dollar to go back down to these levels in here, which I believe are normalized levels. This rip higher was because the Fed jacked up interest rates in an aggressive way, and it led to a pretty ugly market last year. Okay. The dollar broke the downtrend, it had a perfect double bottom. I mean, if this was a stock and I didn't know it was UUP, I'd be buying it like crazy because that's a perfect sell-off, double bottom, breakout above all the key moving averages. I would be buying that like crazy. And then I found it very interesting. I'm trying to figure out, racking my brains, like, why is the dollar breaking out? It's particularly disturbing to me that the dollar is breaking out and treasuries, long-dated treasury bonds are breaking down. That smells to me of a serious danger in the market, and people are hiding in treasury bills. Either that, or it's just, I'm buying treasury bills at 5%. Why would I buy treasury bonds at 3.8? Right? I think TLT yields 3.8. So we're sitting here debating whether or not treasuries, long-dated bonds can go up. How are long-dated bonds going to go up? Who is going to buy a long-dated bond? Who's going to buy TLT at 3.8? Let's just look at this for a second. Is this 3.8? I think I saw it was 3.8. Okay. 2.8. TLT is yielding 2.8. Now, who is it out there that thinks treasuries are about? Who thinks TLT is about to break out to the upside? Who is that? What would compel TLT to break out to the upside? No, I mean, seriously. I can get 5% short-term rates risk-free or take risk to pick up 2.8? The only reason you would do that is that you think the Fed has to start lowering rates immediately. Yet the Fed constantly comes out and tells you they are not lowering rates at all. They're going to probably continue to raise rates. They're certainly not lowering rates this year. Everyone likes to tell me, oh, the betting parlors, the betting departments think that 80% chance they're going to lower rates in December. I don't care. What do I care about betting departments? A bunch of people don't know what they're doing. I mean, that doesn't mean anything to me. Okay? That's a serious problem. If treasuries break down, as they should, why should they? Because money's getting sucked out of long-dated bonds, just like it's getting sucked out of regional banks. Because you can buy treasury bills risk-free through July at over 5%. Even if you thought to yourself, oh, the Fed's going to have to lower rates in December, why would I buy treasuries today? Bonds today? Why would I buy bonds today? Give me the 5% through the end of July, and then maybe I'll start buying bonds. I don't, maybe August, maybe the end of the summer. I don't know. I'm spitballing with you right now with a macro discussion, right? Price action is all. Treasuries turn around, break out. I'm happy to get involved. I've been saying to you guys, if TLT can go above 110, I'm happy to look at it again. In the meantime, what I'm looking at is that chart. And that's a problem. So I thought it was brilliant. Now, Hugh Hendry, let me just tell you a couple of things before you read what I republished. I just cut and pasted it for you. Let me just tell you a couple of things about Hugh, okay? He is like a perennial bear. If you don't know Hugh Hendry, he made his name being short the investment banks and the banks in 2008. He was up 50% in a month because everything crashed. But to put that in perspective, he underperformed for 2 years before he got paid on that. Okay. So, and then after that, he missed the entire bull market and had to close down his hedge fund. So there are no gurus. Okay. So take what I'm saying to you with a grain of salt. Read what he's saying with a grain of salt. I'm not leaping to all the conclusions he's leaping to, right? But what he is saying, he explains very clearly why the Chinese currency is not going to be a reserve currency anytime soon. All that crap you've been reading about, in financial TV about the impending demise of the US dollar, which, by the way, I've been saying to you is not true. And if it does happen, it'll take decades. It's not going to happen next month. But everybody, everybody, Chicken Little, runs around and is convinced that we're going to have a crashing dollar. Okay. That's not what's happening. And what Hugh describes is just, if you can decipher what he's saying and read through it, maybe you have to read it a couple times. But it's his opinion. He's wildly short the Chinese currency. Now, again, he's been calling for the Chinese, real estate collapse forever. He's been wrong. So again, a grain of salt. But I think he is a smart thinker. And when I see price action begin to do something, it helps me understand it. So I'm looking at the dollar. If the dollar's breaking out, okay, this puts pressure on U.S. equities. It puts pressure on commodities, okay? And it puts a lot of pressure on emerging markets. Who remembers when we thought emerging markets, hey, maybe that'll be a great idea. They haven't gone anywhere, and they're about to break down, okay? China is about to break down. China's out there liquefying their own market because they're having a problem with deflation. They're having a deflationary problem, and they're adding liquidity, which is going to further devalue the renminbi. They devalue the renminbi The US dollar goes through the roof. I'm more than happy to revisit this if the dollar breaks down. Crisis averted. But if the dollar keeps going up, now we know why. And if we ever see, I mean, Hugh thinks they're going to devalue. I mean, he's been thinking that forever, and he's been wrong forever. But just like 2008, he was wrong forever until he was right, and he made a goddamn fortune. Now, I'm not saying to invest that way, but I am saying he is a forward thinker. His timing is never right, but he is sharing with you an understanding of what's happening in China and why that narrative that the US dollar is going to continue to go down big because it's going to lose its reserve status is ridiculous. And when we see UUP breaking out and emerging markets breaking down, start putting the pieces together. And we understand the risk monitor is red. And so while 10 stocks have levitated, so market's up this year, Wile E. Coyote is headed, I mean, he's already off the cliff. And it's just a question of, does he look down? I don't know. 3 different styles of management. I go to bed every night with a lot of cash, and I'm just trading the indexes. Going to bed every night with a lot of treasury bills and gold. And then I have a handful of names just to keep me in the game, some capital to work there, right? Using individual algos. There certainly is some money to be made in here if you swing trade quickly. We own TGTX, that worked. We own Eli Lilly, that worked. So there's a way to make some money in this market. But for me, if I put too much into that endeavor, I think that's a mistake, and I can't hold on to it correctly. So small position sizes, right? Keeping our mind lubricated, doing the research. We're going to listen to AI today. They had earnings announcement, stocks up 2%. I'm curious. Okay, so we're going to keep doing research. The risk monitor changes color. I'm happy to put money to work. Everything I just said right now is wildly bearish, right? Market breaks out and we get confluence. Hey, let's put money to work. Until then, those are the 3 styles, and that's how I'm structuring my portfolio. I hope you found it helpful. I look forward to working with you guys today on the desk. I'll see you at 9:30 when the bell rings, and we'll get our live trading desk started. Have a great day, guys.